Hello everybody, this is Oracle K76. I wanted to cover a pretty important topic that I wish I knew about decades ago. Would have been a lot better off now if I knew this then. This isn't actually a new topic. I've been kind of looking at things in the financial world for a while, and for whatever reason I never came across index fund, and you won't typically hear the media talk about it. CNBC, any of your talk show hosts that talk about the financial markets, your financial magazines, they're typically not going to bring this up because it doesn't make them a lot of money. But the topic is index funds, and don't take my word for it. Definitely do some of your own investigations. Google it, look into other sources that talk about it, and determine if it makes sense to you. But hopefully, I'll break it down all the reasons why you should definitely look into this. So this is Investopedia. It's one source you can go to kind of look over what it is and how it works basically. I do want to cover fees because that's really what makes, one of the big things that makes index funds different, is that they're kind of considered passive funds, not active. So they have a lot lower fee. So that's really all of the numbers out there. You can look at all of them, but in reality, now that I understand this, the only thing that really matters is the investing strategy of what you're putting your money into and the cost. And there's a couple of sites here, NerdWallet and also Betterment, that go over just how much it costs. And here they give an example of a 25-year-old with 25,000 in a retirement account. They're adding 10,000 a year, 7% return, and they plan to retire in 40 years. So that 1% fee would cost them over $590,000. So that this just breaks down, and you can go to the site. I'll post this link in the comments below. Here's another one for Betterment. Basically, it shows an 8% return with a 1% cost and a 0.26% cost. Now these are expense ratio costs they're talking about. There's actually a lot more costs that go into mutual funds that I'll talk about in a second. But you can see over here at the 30-year point, the difference between just 0.26 and 1 is $174,000. So that you can see the significance of this in the numbers basically. Now that's just some of the numbers, that's not all of them. So let me first, though, I want to go over some funds and show these graphs. So what these graphs do is they show you certain funds versus the Dow Jones basically. And in this drawing here, this yellow is the Dow Jones, and then the bluish is the actual Janus Henderson Balance Fund. I just picked a couple random ones just to show you. And you can see that this one actually performed rather poorly. Some of them will beat the Dow Jones sometimes, but you can see that there's a huge difference, a huge gap here between how the Dow Jones is performing versus how this mutual fund. So like I said, there's all kinds of numbers on the screen. What we're going to talk about is really this expense ratio, which 0.72 is not bad, honestly. Anything less than 1% is good. The lower the better, because those numbers, especially over 20 and 30 years, the compounding really makes a difference. So the expense is something you want to look at. If it has a 12B1 fee, you don't want anything with the 12B1 fee. Now the other thing, and I'll talk about why this is important in a second, is turnover. So this turnover is 60%. What that turnover is how much of the stocks that they have, because a mutual fund is nothing but a bunch of stocks, and it's how much of that inventory of stock they're buying and selling. When they buy and sell these, there's a whole bunch of fees that aren't going to be in your prospectus, your expense ratio report. They're not going to show up there. They are in some of the other fund information they put out, but most people don't dig into that. But essentially, they're saying that out of all the stocks they own, they're buying and selling 60% of them. And every time they buy and sell stocks, the costs that you're not seeing directly are the taxes, because that's a capital gain if they actually made money on it. If they didn't hold it for longer than a certain period of year, they're paying short-term capital gains instead of long-term capital gains, which is a pretty big difference. I'm not going to dive into all of these. There are books out there that dive into all the specific and all the numbers. the purpose of this video is not to go over all the in-depth information. If you want that, you can ping me and I'll give you even more books that go over all the numbers if you really want to know them all. I'm trying to keep this at a high level and not too complex, basically. So that's one of them. That's Janus. The next one, I'm just, again, randomly picking these. This is Aspera Growth Fund A. And you can see this one has expense of 2.65. Let me repeat that again, 2.65. And this is astronomical. These are the funds that you're going to see advertised. This is where they're making all their money because they're charging you a ridiculous amount of money to take best guesses to try and beat the Dow Jones. And this one you can see, again, the yellow is the Dow Jones, the blue is the Sparrow Fund. And you can see right here, it actually did beat the Dow Jones for a period of time. But in the end, the Dow Jones, beats it most of the time. So in reality, they will sometimes beat the market. That's what you're paying that 2.65% for. You're paying it in the hopes that, yeah, they'll beat it. And there's a whole bunch of books I've read that go over the psychology of it, about it's almost gambling. And index funds are not the same way. Index funds are if you want to be logical about it and not try and beat the market, but instead be the market. So let me go back to expenses. 2.65, ridiculously high. And it even says here's a high fee level. Look at this, 256% turnover. That means that over 2.5 of all the stocks that they had, they bought and sold. And again, you're not going to see, this is on top of the expense ratio. So you're going to pay this 2.65, even if they did nothing, you're going to pay that fee. And then this 256% turnover, you're paying capital gains taxes on that. So some of the other things, I'll dive into that now. Some of the other fees that you're not going to see up front is there's a difference between the bid and the ask whenever they buy stocks. And there's actually ways they deal with that, and there's a fee involved, obviously, and that comes out of your profits. So if the difference between what they try to sell or buy the stock versus what it goes for, there's kind of a fee for that. It's in the background. You're not going to see it directly, but it's part of what prevents the stock, your mutual fund, from performing as well. And the more that they buy and sell stock, the more they pay this difference between the bid and the ask. Which, by the way, a lot of these companies have deals with the companies that take care of that difference between the bid and the ask, and they actually get a kickback. So the people running this, when they buy and sell this turnover amount, they're getting a portion of that back as profits to the management, not to you, but the people that are actually buying and selling the stocks. And that's one of the reasons they buy and sell so much, is they actually get a kickback from that. So another thing to be aware of is the size of the fund, which this one is 16.4 million, not too big. This one isn't a big problem here, but as these mutual funds get bigger and bigger, they get to a point where they're not able to buy shares of stock at the same price. Let's say AT&T goes down and they want to buy a bunch of shares. Well, because they have so much money and they're buying so many shares, when they start buying those shares, they drive the price up. So they may have started buying the shares at a good price, but then eventually, because of so many shares, so much dollars are involved, then they aren't able to sell it or buy it at a reduced price anymore. Now they've actually priced themselves out of it. Kind of complex how that works, but just know that the larger a fund gets, the less advantage it has when it's buying and selling stocks, basically. It's like a big immovable giant, and it costs it more and more to make moves with stock. It's not always a bad thing to have a lot of assets. It's just bad if you're trying to buy and sell a lot of stock, like doing a 256% turnover. So those are the major costs, the ones you need to know about, really. So those are two regular mutual funds. Now I'm going to go into an index fund. I will admit that I'm a Vanguard fan. I'm starting to invest in them, so I do have some skin in the game in this. I will show you a site that lists some non-Vanguard funds if you want to not use them. Again, recommend looking up Vanguard, see what you think of the company. But I just want to say I do invest in Vanguard, so I do have skin in the game here. All right, so this one actually isn't a mutual fund, so it looks a little bit differently. It works the same exact way as a mutual fund, really. This is an ETF. But what I want to show you is the expense 0.04. Yes, that's right, 0.04. So compare that to this, which is 2.65. That's 2.2% less. And when we went over the numbers over here, we were talking about 1%. So now we're talking a 2% difference. That's $350,000 difference over a 30-year period. So again, this isn't the mutual fund. I think is actually at 0.15, which I guess I should pull that up right now. Let me go to Vanguard. VO. So just, I'll do this real quick. Just so you know, this is what the Vanguard site looks like. This is the ETF. Let me do investor shares. So that's VFINX. So 0.14 is what it has. Let me go back and do the same thing for this. So Morningstar, just if you're not familiar with it, what it does is it tracks all these funds. It's not backing any specific company, but they're pretty well known for tracking how companies are doing. So again, this is the mutual fund version of what I was just showing a second ago. Now this one has 0.14, so it's higher than the other one, but it's still 0.14 compared to 2.46. The turnover, 3%. 3% compared to 256%. So it's a lot lower, and this is considered a passive fund because it's not buying and selling stock all the time. These other two, they're actively managed, meaning that they have people that look at the markets and look at the press reports and all that, and they make decisions and they buy and sell stock. The index fund picks an index, and this specific one is the Vanguard 500. It picks I'm sure you've heard of the S&P 500. It picks those stocks or a percentage of them and has a percentage share of each of the companies. So the only time they buy and sell is whenever a company goes out of the S&P 500 or a new one comes in, then they may buy some of that or may sell some of it. But 3% is, anything less than probably 20 or 30% is good. Over 100% is ridiculous. Over 50% isn't good, but definitely single digits is good. All right, so assets 403 billion, so you can see it's pretty big. So if they were transaction often, they would have problems, but they're not going to do that. And now we look at the graph, and what I want to show here is, again, this is the blue is the stock we're talking about. I need to benchmark it to the Dow Jones. US indices, Dow Jones. So Dow Jones is the yellow, and then the blue is us. So you can see it pretty much goes right along with it because it's tracking the same stock that makes up most of, this is only 500 of them. There's a lot more in the Dow Jones, but my point is that it's not going to typically beat it, but it's also not going to be way less than it. It's usually going to match the Dow Jones. Whereas these, there's going to be differences, right? Sometimes they're going to beat it. Sometimes the Dow Jones is going to be better. The index fund is going to be whatever the Dow Jones or whatever index it's following, that's what it's going to do. Now, one thing to say about index funds is they're indexed on something. You have to pay attention to what that index is. Is it the S&P 500? Is it the Russell 2000, et cetera, et cetera? S&P 500 is probably one of the easiest to track, but there are some others. I do want to pull up this Bogglehead site. So if you're not familiar with it, Boggleheads are a group of people that were basically fans of John Bogle, who founded Vanguard. So obviously they're going to favor Vanguard. But I wanted to pull up this site, and I'll provide the link in the description below. They actually do provide not just Vanguard funds, but index funds with some of the big companies out there: Charles Schwab, Fidelity, T. Rowe Price, TFP, TIAA. So here you have some index funds and from different companies, and they're typically going to be low cost. Like, let me just pull up, hopefully this has the expense ratio pretty easy. So turnover is 3%, which is good. It's passive, and there it is. There's the 0.03% expense ratio. So that's pretty good. So anything less than 1 is good. The lower the better. And then this slide also tells you, how you can split up. I'm not going to talk about your actual fund layout. I just want to talk about what index funds are, provide some examples. So let's see, I've talked about what they are, talked about fees, I've shown over the expense ratio, turnover, talked about the hidden fees such as taxes, long-term, short-term, the size of the firm, how big the fund is, the differences between the bid and ask whenever you buy a stock. Oh yeah, so fund numbers. So a lot of times when you go to buy stock, and I should go back to that Charles Schwab, they'll probably have it. So they'll typically have their numbers in a chart like this that'll have 1, 3, 5, 10 years, stuff like that. So here's something that makes it really hard for the analyzers to analyze index fund, mutual funds versus the regular ones, the active ones. A lot of the active funds, if they do bad enough or when they start doing bad, they get rid of them. They either disband it or they actually absorb it into another mutual fund, and that's why you won't see too many mutual funds out there that have 10, 15, 20 years of all really bad numbers, because they make those numbers go away. So index funds have been around since the late 70s. Vanguard was the first one to have it. So those numbers are out there, but in tracking long term, in some of the books I can provide you with, if you ask me, you can see that at play, that it's hard to track because they don't last that long. All right, so this shows you the 3-fund portfolio. I won't talk about that. I don't want to sidetrack too much. I do want to talk about a recommended book. There's a bunch of books I'll probably do reviews for later on, but this is one of them I definitely recommend. The Coffee House Investor. It basically talks about why you should do index funds and don't waste a whole bunch of time with other stuff. It's 176 pages. It's not super technical. I would say it's high school level easily. So this one's $16 for hardcover, paperback. Or they have some used ones for $3.50. So your library may have it too. Definitely recommend this book. That'll kind of go over why index funds are important. I recommend Googling it on your own. Look at YouTube's videos, look at Reddit to get some more information. Don't just take my word on it. So if you have any questions that I didn't cover as far as index funds, put them in the comments below. Also, if you have any stories where you've figured out about index funds, or you've been doing index funds for a while, or you realize that you have really high expense ratio mutual funds, you want to share that, please feel free below so that hopefully other people can learn. Like that's what I'm trying to do here, is I've definitely had some companies where I had a high expense ratio, and I'm trying to help you guys out so that you can save money and have more money in retirement, hopefully. And finally, if you have any other book recommendations besides Coffee House Investor, or any sites that you recommend people check out, leave those in the comments below so other people can read it. And thanks for listening. Have a great day.